Is stablecoin the end of fractional reserve banking in emerging markets? This is a question that I have been thinking a lot about this week. And the question that I'm also asking myself is like, are USD backed stablecoins simply a savings innovation? Or could they unravel the banking systems of weaker economies by
Mm-hmm.
hollowing out the very mechanism that fuels this credit growth? So let me actually break it down what I'm talking about here. For example, how big are stablecoins today? The stablecoin market is at a market cap of about $250 billion. That means $250 billion worth of USDTs and USDCs and some
Right.
other smaller stablecoins are in circulation today. Of that entire supply, it's about like 50 to 60 billion dollars is in the Latin American market. So of the total supply, there are about 50 to 60 billion dollars worth of stable coins are in the Latin American market.
Mm-hmm.
The Latin American market alone received a total of 400 billion plus dollars in crypto volume in the last year, about from let's say June July of 2023 to June July of 2024. And what does it that mean exactly? So of this volume, let's just say in Argentina, of the total crypto activities, of the total crypto volume that Argentina received, 60% of that was in stable coins. So what that
Mm-hmm.
means is people in Argentina are either transacting in stable coins, saving in interest stable coin, or doing whatever else they would otherwise do using stable
Mm-hmm.
coins. Let's say investing in crypto in stable coins, for example, or buying any other tokenized assets in stable coin, for example. What does that mean? It means like in place of using their native currency, whether you are in Argentina, you are in Brazil, you are in Ecuador,
Mm-hmm.
you are using USD, a proxy of USD in the form of a stable coin as your primary currency, and you are interacting with a market that has nothing to do with the Argentinian economy or with the Brazilian economy, and that market is not controlled or dictated by the central banks in this region. What that simply means is that these banks are not benefiting from whatever financial activities that you are doing. These banks do not cannot control your financial activities. These banks cannot, let's say, in any case, whatever monetary policy that they are deploying in any kind of economy, it does simply does not affect you. Now obviously from an individual perspective, it makes a ton of sense that why would you want to be controlled or dictated to by let's say a weak economy, and even some in
Right.
cases a corrupt economy. So you are opting out. When you're opting out, obviously your local bank, your local economy is losing out on your money, and at the same time
Mm-hmm.
the US economy, the US Federal Reserve, is
Yeah.
actually making money.
Getting strong.
Yeah, yeah, right. So basically, because why? Let me actually show you some data on the Latin American crypto market before we continue. This is
Mm-hmm.
a report from Chain Analysis dated from July 2023 to June 2024. And of the entire world's volume, Latin America alone did 9.1% in cryptocurrency value received. That amount is about $415 billion.
Jeez.
So this 400 and of this $415 billion, let me find out where Argentina is in this list. So Argentina alone is
Ah,
getting about
on the
90 billion
top.
dollars out of it, right? Like of the 415 billion, $50 billion, Argentina is getting 91 billion, and Brazil is getting 90 billion. So
90.
these two countries alone are bringing in about 181 billion of that $415 billion. And what's more interesting is that 60% of this $91.1 billion is in stable coins. So that 60%, as I was saying, is about $54 billion that's simply in stable coins. Now why am I mentioning this? Is like this 54 billion, this is directly benefiting the US government in one way or the
Mm-hmm.
other. What does that mean? Well, what stable coin are you using? You are either since you are in Latin America, you are most likely benefiting from you're most likely using the USDT, the stable coin issued
Secured
by
usage.
Tether. Yeah. So and what does Tether use?
Like backed by
Yeah,
US government bonds.
yeah, exactly. So what are in Tether's reserve, about 80% of Tether's asset is in US treasuries, US repo agreements, and and some amount of cash holdings in USD. So you were buying from a company, you are using a company's product that is in turn paying the US government for the privilege to be able to issue these stable coins. So even while you were staying in Brazil, even while you were staying in Argentina, you were enriching the US government. And while your own country's government loses out. So as like it's a great news for the US economy. It's a great news for the US Federal Reserve because they are doing the right thing here. They have rightly identified stablecoins to be an untapped resource for trillions of dollars of revenue in the coming decades. That's why they are in such a hurry of approving stablecoin regulations, of like creating regulation and creating frameworks where none existed even a few months ago. And obviously we are not complaining, right? We are in the stablecoin business and we want the market to grow as fast as possible, and basically like grow in market cap as big as possible. So but let's look at the other side of this scenario, like who is losing out. And it's very clear to me that
Yeah. The
these
countries like Argentina and all of that.
yes, this emerging market weaker economies are somewhat losing out in a lot of potential revenue they might be getting. So now let's go through one by one how exactly are they losing out. The number one thing that they're losing out on is through deposit disintermediation. They're losing out on a shrinking money supply. What does that mean? We all know that the global economy runs on fractional reserve banking. Like the free world, the capitalist world, it runs on fractional reserve banking. That means banks create money out of thin air. Like whatever amount you deposit in the bank, they keep a fraction of it, they lend the rest of
Lend
it
it
out.
to those.
And
Yeah.
whoever you were lending it to, they store it in the bank, and then the bank basically again
Their
keep.
bank. Yeah.
Yeah, yeah, exactly. Like it's a circle of debt creation. It's a circle of credit creation.
Credit creation.
Uh, yeah, to a point where, like in any economies, like $1 becomes $2 or $3, or even sometimes, like for example, like just before the 2008 financial crisis, the U.S. government, the U.S. Fed was creating $8 out of $1. So like it's called the M0 M1 ratio, and that M1 M0 M1 ratio was at 8x 8x of in that market, in that economy. So let me actually quickly share my screen again and show you the where the fuck is it? I don't have it. I should have it. Yep, got it. Yeah. So at that point, the M1 M0 ratio was at 8x. Now the United States has the M1 M0 ratio at
Also,
3.
Romeo,
Yeah.
start it again and zoom it a bit because people can't see.
Oh, sure. So yeah. So back then the M1 M0 ratio in
Wait,
the
wait,
US
wait,
was
wait.
at.
It
Yeah, I
isn't
will. I
zoomed
will.
yet. Just press
No, no.
Control plus.
Yeah, I know. I know. I will do it.
Sure.
Yeah, so if you look at this chart today in the United States, the M1 M0 ratio is at 3.3x, which means like for every $1, the United States is creating $3.3 out of it.
$3.
Yeah, like Canada is doing 2.8x, United Kingdom is doing 2.5x. So as you can see, like every single country creates debt, creates credit from their fractional reserves that they hold. Now the problem is, let's say the amount of money that they have circulating in the economy goes down. What does that mean? That means their opportunity for creating credit also goes down, since their money supply is shrinking. And the shrinking money supply is never a good news, because the effects trickle down.
Right.
In a fractional reserve banking economy, the trickle down effects are truly noticeable. So let's just think of a scenario where let's say the money supply has shrunk by 10%. What does that mean? Like how does this 10% money shrunk money supply affect you? Like if you are a student of economics, you know what like M0, M1, M2 money supply are. So let's just say that M1 money supply has shrunk by 10%. That means that the bank has to recall about 10% of their current debt that they have in the market. So that means some small or medium businesses or some businesses has to pay off their debt out like before time, or so some businesses are not going to get the rate at the interest rate that they had thought they will get it. And also, since the money supply is shrinking, the bank has to raise the interest rate, because when supply goes down, the demand for that same loan goes up, and therefore you have to increase the interest rate. And whenever you are increasing the interest rate, you are creating pressure on the economy, and the economy doesn't
It
like
limits
pressure.
the growth of the economy.
Yeah. It completely chokes the growth out of the economy.
Yeah, choking
And
is a better word.
yeah. And what these small businesses will do then, they will have to be forced to lay off people. They will have to cut down. Some of them will have to declare bankruptcy. And whenever small and medium businesses are going down, that means your country is in dire economic condition. So, like, just let's say when the money supply shrinks by 1%, 2%, you don't feel it that much.
Yeah,
But whenever the money supply goes down
the
by
10%.
10%, yeah, it gets noticeably worse. And everyone from the regional banks, because again, like now I told you about, like, they have to increase the rate of interest on the loans that they give out. But what about to entice people to keep their money deposited in their business, in their bank? Like, what about that, right? Because in a troubled economy, people tend to take their money out of the bank because they don't trust the bank. People tend to take out their money out of the bank and invest in something like gold, invest in, or simply buy some foreign currencies that are not so much in trouble. So then the bank is losing out on deposits as well. Like, the more they lose out on deposits, the more pressure they feel on the credit side of things, and it just basically it's a death spiral, right? It's a
Right.
never-ending circle that ends in complete destruction of the economy. So yeah, so what they will have to do, like, if you are a customer in a bank and you want to take your money out of the bank, you will need a very good reason not to do that. And that good reason is that the bank is willing to pay you more in interest rates. So what that means is this increased interest rate that the bank is paying you is eating in their profit, in their quarterly profits. And whenever it's eating in their profits, that means the bank is losing money. So that means, like, really small banks who does not have a lifeline of billions and billions of dollars, they are simply going to go down. So that's
That
just one.
that
Yeah,
was
that's
really well explained.
yeah, thanks. Yeah, so basically that's just one side of uh one side of what this the stablecoin uh leading the fuck. Let's try again. Yeah, so that's just one side of the equation, right? That's just one part of in this entire picture. Then let's take a look at another one, which is remittances, which again does the same thing basically. Like, uh, if remittances increase in stable coins instead of going through the traditional means of someone sends you money from their bank to your bank, like internationally, then your bank gets to keep the foreign currency, whatever, like be it USD, Euro, or rubles or whatever, and then they give you the equivalent amount in your native currency, minus some foreign exchange fees and some other fees. And basically, you never get to see that USD in your bank account. What you only
Right.
have access to is the native currency that your bank gives to you. So that means, like, the higher the remittances, the higher the supply of foreign currency in your country's central bank. Yeah, now let's say you don't send your money through traditional banks, and you just simply you decide to use stable coins to send money home. What that means is the money never reaches the central bank or even in any regional banks. It goes directly into your wallet. And now, when you
Right.
finally decide to spend some of that money in your local currency, only then you sell that specific amount, and then you go about your life. And if you decide to simply save in the US dollars because your local currency is weak, it's high, it's extremely prone to inflation, you don't really trust the monetary policies of your local government, then you'd never use it, or basically use it as little as possible and save it for later. And however much you are saving, be it just a few $1,000 or a few $1 million, it never reaches it never gets the exposure to your local economy. That means your local economy
Right.
doesn't benefit from it, right? And if like the lower your foreign currency reserve is, for like the lower the country's foreign currency reserve, the lower the foreign currency reserve of the central bank, the lower its like the more susceptible to economic turbulence that country is, because you always want like a robust foreign currency reserve. So you look at countries like the Middle Eastern countries, like Kuwait, Qatar, Dubai, Saudi Arabia. What all of these countries are extremely rich in USD reserves, simply because they are selling their oils in USD. So you look at the Kuwaiti dinar, or you look at the dirham, or the real, all of this, you will see like the conversion rate between the USD and these Middle Eastern currencies. These Middle Eastern currencies are much more valuable than the USD itself, because they have the reserve of USDs and that's their primary asset, and they have so much that they have pegged their USD, their local currency, 2x, 3x, or 4x of the United States dollar, simply by power of that specific dollar, because like whatever their circulating supply is, whatever the size of their economy is, they have 3x their reserve in USD. What happens when you don't? What happens when your like inflow of USD is lower than the outflow of your USD? That means you are living in an inherently weak economy that is susceptible to many kinds of dangers,
Mm.
right? And yeah, so that's the remittance problem. And the third problem that I have identified is it's a dollarization feedback loop. What means is like in your own country, your native currency starts losing importance. Like it's not
Right.
like it's not the primary currency anymore in that economy. It essentially becomes like the secondary currency, whereas you create this parallel currency market where USD or any other powerful stablecoin led currency is actually doing the primary dealings. So that means you are losing importance of your currency is losing importance in your own
Importance in your own
economy.
country.
Yeah, and guess what? Like your central bank cannot set policies around USDs. Your central bank can only create policies for
Around
your
the
own currency.
country's currency.
Yeah, exactly. So that means even if you do have money, even if your people are doing fine, let's say GDP per capita, they are doing well, they have a good savings. None of that, none of that is thanks to you. And in a turbulent economy, you cannot create any policies. You cannot dictate any policies because your currency doesn't have any value. Your currency doesn't have any importance. So whatever, yeah, let's say you increase the interest rate, it doesn't really have any effect because nobody is using the currency, so forget about that. Yeah, the more people in your country start using stable coins, the more value that your currency loses, and the less significant your own local reserve bank or your local central bank becomes. But it is good for someone, it's good for home, it's good for individuals who are
Right.
actually using these stable coins, because like in our previous episodes we have looked into how crazy some of the forex fees are. Like some countries like Philippines, the traditional banks or fintechs will charge you like 6%, 7% to convert foreign currency into your local currency. If you lose 7% of your total paycheck just to a conversion, even before taxes, how much are you left with at the end of the day? It's ridiculous, right? And when you're using stable coins, that amount is, the transaction fee goes to less than 1%. So it's the net benefit goes to the actual user who is receiving or who is transacting in stable coins. That's just on the transaction fees. Then also you have inflations, and we have discussed inflation endlessly in our previous episodes. So, in countries like Venezuela that has previously experienced inflations as high as 230%, can you imagine living in a country with that high inflation? You are losing
Right.
like almost nearly 70%, 80% of your earnings, just of your savings, just to inflation. So what you want to do is you want to hold in stable currencies and stable coins that are quite literally stable currencies,
Yeah,
right?
true.
Yeah. So stable coins is the ultimate inflation killer. So whether you are in Argentina or Lebanon or Turkey, savings in stable coins, you can protect whatever amount you want. It doesn't matter. Like even if you earn only $200 a month, which is a good starting point in countries like this, in developing countries like Argentina, like India,
Hmm.
uh, like Philippines, right? So like stable coins makes a lot of sense. And on top of that, it's really simple to use. Like if you're using stable coins, all you need is first of all, the settlements are instant, the transaction fees are
We
very
have
low.
discussed all these advantages in the first episode itself, like how faster it is, how cheaper it
Yes.
is.
Yeah, exactly, because these are so who is benefiting from all of these things? The users who are using and
The
transacting in stable coins
individuals.
are the ones that are benefiting. And um, and who is losing out? Losing The banks are losing out. The central banks, the regional banks, the local, let's say, the even the local businesses who are going to be who are feeling the backlash, who are feeling the second order effects on the economy when stablecoin usage goes up. So
Can you tell me what will be the second order effects for the small and medium sized
yeah,
businesses?
like the second order effect here is like it gets incredibly difficult for them to get loans because the money supply is
Okay,
shrinking,
I
as
see.
we discussed earlier, right? So that will be a second order effect on the businesses. And then the third order effect will be on the people who are losing money because they are losing their jobs, right? uh, yeah. So the question then becomes, what do you do to to, to create an economy that is not susceptible to complete destruction, like to avoid financial Armageddon, if your people start using stablecoins. You have to do a few things. First of all, you have to look into your, like, forget about inflation. Let's just look into your financial infrastructure. Have you really embraced the fintech revolution that came a couple of decades ago? What kind of internal payment rails have you built? What kind of infrastructure have you built for your people who doesn't have to go to bank or go to an ATM to withdraw cash and then do transactions, or who has to use like Visa or Mastercard, and then whenever you are using these cards, you are giving like 3%, 4% on fees. So you are losing out on again like high transaction fees, and people don't want to do this stuff. So they want almost uh, intuitive financial infrastructure where they can like seamlessly transact with each other. Like we have in India the UPI system. All you need is a bank account. Your phone's app will connect to the bank account, and then you just scan a QR code and pay whatever amount you want to pay to whoever, right? That's just as easy as that. And it settles 24/7, 365
Hmm.
days. It never goes down. You are paying zero in transaction
Yeah,
fees.
and there isn't any transaction fees, right?
Yeah, yeah. Like we have that in India. Brazil has that with
Pigs.
the PIC system, right? So it matters that the infrastructure is robust enough that it can facilitate millions and millions of transactions every day, that it's fast enough, the design is intuitive enough that it doesn't like feel super difficult. Like for example, to do a transfer, you have to know the account number, the Swift code, the IFSC number, or the routing number.
Yeah.
These are like just the many amounts of numbers that you have. And then again, like if the transaction amount is super high, the bank will ask you like, what is this transaction regarding? We'll
Hmm.
need to see some proof, and then it just gets ridiculously difficult every step of the way. Yeah, so obviously the first thing that you need to do as a country is to get your financial infrastructure up to the snuff so that people can actually use it. And then comes the question of like, how weak is your economy, or like how weak is your currency, to the point like if inflation is rampant, it doesn't matter how good of an infrastructure you have. Like if people are losing money just by holding it, they're not going to hold it for very long. So you need to understand you need to fix inflation, and it's not really that difficult to fix inflation. Like even in like let's say even in like extremely weak economies, you can just observe the financial situation, observe the economy for a few minutes, and then you'll be able to pinpoint like why is there inflation. It's either because like some are obviously in your control, some conditions are not in your control, like in natural disasters, war. I mean, war is in your control to the most extent, like for natural disaster is being one, like a pandemic being one. And these things are not in your control, and these really do disrupt the financial infrastructure of a country to a certain point, right? Like if there is a severe flood in a country, in a small country, and most of the agricultural lands are underwater, then you are
Wipe
not
out.
obviously going
Right.
to have any agriculture, right? But that is actually that is actually the exception. The primary reasons why it happens is primarily because arbitrary financial policies that make no sense. Like you have debt, okay, let's print a bunch of money and pay off that debt. And when
Right.
you try to do that, what happens is, when you try to do that, you
The
create.
currency loses value, right?
Yes, yes, yes. Your currency loses value. Or for example, you decide to elect a socialist government that comes up with wacky laws that basically says that we are going to pay people for free. You don't have to pay for anything. We are going to nationalize everything, like healthcare, like education, like it will make it incredibly difficult for people to start businesses. We will tax the rich to such a heavy degree that the rich will just decide to leave the country, because like tax the rich is such a stupid argument. It's like the rich don't want to get taxed. Like if you go up to a billionaire and say like, give me 50% of your earnings, they will leave the country the next day because they have the option to do that. No, so whenever you are taxing the rich, what you are doing is depriving your own economy of precious dollars. That's all you are doing. And the net productivity of your country goes to zero, goes down, and you lose out on money. Or you decide to start a meaningless war with a neighboring country, and just basically the defense budget is killing you. You don't have any money for education, for health, for R&D, for any basic stuff. So like the people who should have been farming, the people who should have been studying engineering and building stuff are now dying in your meaningless war. And we have seen a fair share of meaningless war in just the last 10 years. So
Right.
you can directly pinpoint reasons why an economy is underperforming, or why there is rampant inflation. Like for example, do you know what country has the biggest oil reserve in the world?
No. Some Middle Eastern country, I'm guessing, but I can't tell
No,
you.
it's Venezuela.
Okay.
Venezuela has the largest oil reserve in the world, and their economy is one of the weakest in the world.
Yeah, how is
Because,
that?
well, it didn't used to be weak. They suddenly they decided to elect a communist government 20 years ago, and everything went down from there on. So, like even like you have the most money of any countries, just through your oil reserve, and what you decide to do, you don't use it. You decide to do something stupid to your economy, and when you do stupid things, you win stupid prizes, and you see 230% inflation.
Right.
Yeah. Actually, I went on a rant and forgot what I was talking about. All right. Yeah. So control your inflation, your economy will stabilize. Build financial infrastructure for people to transact with each other seamlessly, and you won't be seeing so much of an outflow to stable coins, or at least not today. At least not today. At least not in the next 5 to 10 years, because yeah, yeah. And then there are some things that you can do which are net negative in the long run, which is like you might try to pass some laws that restrict stablecoin users in your country. Yeah, like because some countries will definitely have this idea, because they feel like it's best to stop innovation in its steps. Like if innovation is threatening us, then we'll just stop innovation. And what
Right.
happens is like 20 years from now, they will look back and see like, okay, that was a mistake. Like the Indian government decided to stop the rollout of computers back in the 1970s.
Yes.
And we massively lost out on development
Lost
for
out.
20
Yep.
years. Like it took us 20 years to recover from that one stupid decision, one stupid and again socialist decision.
Like people thought how computers would take up jobs, like take out the
Yes.
jobs, take out the employed people, but in return it just added more jobs. Now it's AI again.
Yeah, exactly. And that's the issue, right? Like there are people who won't do anything productive, but they will do their best to stop innovation and be as
Right.
counterproductive as possible. So like
It's a
some of
very
these
lazy
countries,
approach.
yeah, some of these countries will have the bright idea to, okay, we'll ban stablecoins in our country, or we will
Yeah.
like we will levy like high taxes on whoever uses stablecoins. Um, and some might also have the idea, which I don't totally like see if it's a bad thing or not. Some might insist on having like have these stable coins create a native reserve. So like if a stable coin is issuing stable USD stable
Ah,
coins in Argentina, the Argentine government may say like, okay, you need to have this amount of peso in your treasury for you to be able to work in uh, Argentina, or something like that. Like I don't know.
that's still sensible.
Yeah, it's somewhat sensible, but like as long as it's somewhat sensible and it makes sense for both the company, the users, and the country, then yeah, sure,
Hmm.
go on. But again, like if you decide to create nonsensical regulations like banning stablecoins, or there is one big one, which is like the countries will say see that these stablecoins are doing really well, so how about we just create our own CBDCs, like your government issued stablecoins. And we have discussed at
Yeah.
length in the last episode why CBDCs are a bad idea. So yeah, so there is a few ways to maintain economic superiority even when you have a fair amount of supply of stablecoin circulating in your economy. Number one, have like really good financial infrastructure. Number two, have a healthy, stable economy with a stable amount of inflation. Number three, like even if like I will say don't do it, but even if countries that do decide to regulate foreign stable coins, do it sensibly so that it makes sense for all parties involved in a transaction, and then there are some stupid ideas like completely banning stablecoins, creating CBDCs, like levying extreme amount of taxes. If you do these things, you are simply trying to stop innovation in its steps, and that's never a good idea. But having said all of this stuff, let me tell you why I don't think that stablecoins are going to dominate emerging markets, or at least the large proportion of the emerging market that is stable, because of a few reasons actually. I don't believe that stablecoin is going to be replacing these native currencies within the next 5 to 10 years. Primarily, number one is because infrastructure. We don't have the proper infrastructure today for me to pay to while buying, like shopping for grocery and paying in stable coins. I do not have that infrastructure available to me today. I might have it 5 years from now. I'm pretty sure that I will have it 5 years from now, depending on like what innovation curve we are on, and what kind of innovation curve the entire globe is on, right? And I'm pretty optimistic that we are going to have extremely advanced level of stablecoin infrastructure in the next 5 years. So even if we do solve the infrastructure issue, the thing is, people will not be super eager to use a completely foreign currency to do simple transactions like
Right.
buying groceries, or buying a mobile phone, or paying rent, or even like going as high as buying a property, buying a car. These are all going to be dominated by native currencies, because it's not only easy to do, but it's also like you are intuitively designed to
Yeah.
use
To
native
see it
currency.
as more secure.
Yeah, and also, even if you are a very tech savvy person, who is like on top of all of these financial innovations, the people that you are dealing with won't be, and the people who you are dealing
Right.
with will never bother to learn about stable coins unless it's in their interest to do so, and it's only in their interest to do so when the economy is in the shits.
Mm.
you know
Wow.
like
Yeah.
it circle backs to my point that if you have a stable enough economy, you are going to maintain your supremacy in
Native
your
currency.
native currency, exactly. So yeah, that's actually the argument that I'm trying to make. And also, let me just extend it a bit further. So like local businesses are not going to accept stable coins because they don't need to. uh, and you won't be able to invest, like the primary investing that you do is not in crypto. Like leaving the biggest crypto degens in the world, which is about, let's 0.001% of the global population. Everyone else still want to invest in their current in their native stock exchange, right? If you're in Europe, if you're in India, if you are in Hong Kong, if you're in the United States, you want to invest in your native stock exchange, and the only way to do that is through your native currency. Like you buy mutual fund stocks, you buy ETFs and stuff like that. Obviously, of course, that tokenized stocks are coming along, and there will be at some point in the next 5 years when tokenized stocks will be a very common thing. But still, I don't see, like, in the next 5 years, yeah, sure, US is going to innovate and embrace tokenized stocks, but I don't see the rest of the world doing it in the next 5 years or even in the next 10 years. So it will be a slow development on that side as well. So yeah, as I said, like, unless entire legal, financial, and commercial infrastructure are rebuilt around stablecoins, and unless trust in fiat totally collapses, mass transactional displacement won't happen in stable emergent markets anytime soon. Not because the infrastructure won't be there, it will, but because most people won't go through the trouble of transacting in a foreign currency unless the native currency is in dire trouble, i.e., 10%, 15%, 20%, or even higher than that in inflation.
Mm-hmm.
So what we are seeing right now is that stablecoins are a savings and remittance innovation, not a universal currency replacement. And number two is policymakers have time to adapt, but only if they act before crisis-driven flight forces their hand. And by crisis-driven flight, by that I mean like panics, economic panics. The economy is collapsing, inflation is very high, there is a war, there is a famine, etc., etc., etc. Yeah, that's pretty much what I'm looking at. But before I end, like, just to stress on the fact that what I told you about, like, stable economies are going to be like, we won't really face any of these troubles, like at least not at a significant level where they are seeing their M1 money supply shrink by 10% or more. But there are already proven markets where, even before the creation of stable coins, like people in Nigeria, they were saving in USDs, like they were literally going to forex bureaus, or they were going to middlemen who sell
Middle.
USDs, and they would buy USDs against their native currency of naira, for example. Like the Ethiopian people did the same thing. Let me see if I can find the chart here. Yeah, so if you look at Africa's USD flow imbalance, like this is the major African countries. I'm actually, like, I found this blog called Lava Writing. This is, I think, run by a VC. Really interesting piece. And just to show you this chart, like the total inflows in USD is 921 billion in 2024, and the total outflow was 1.3 trillion dollars. What that means is they have a nearly like 400 billion in deficits, in USD deficits.
Right.
So that's not a good thing. That's never a good thing. Like if your economy is suffering this much, as that it forces the citizens' hands to the point that they have to rely on a foreign currency for their savings, or for like heavy, like high amount of transactions, then you are most definitely in dire trouble, and stablecoin is going to put your economy in jeopardy sooner rather than later.
Yeah.
And that's about it. Like what I wanted to cover today. What do you think?
Yeah, it's really good. Something that I'm curious about, because we only discussed that the utility of stablecoins only is there when the economy is like messed up. So, how do countries with stable economies like, trust? Like, how do they make the transition? Is there a way? Is there any theory? Is there any hypothetical situation that has been talked about? Or like, what are you thinking?
Yeah. So primarily, the primary use case of stablecoins in stable economies will be around remittances.
Okay.
Will be like the international transactions. That's number one. And number two is, like, when tokenization comes in full fledges, that everything is tokenized,
So
stocks,
stable.
bonds,
So
private credit.
what you mean is stablecoin will still be useful, but in different cases. Whereas in countries like Venezuela, Argentina, they are like stablecoin is. like the majorly
Is the
people would
primary
choose
currency.
stable. Yeah.
Yes. Yeah. But in a stable economy, stable coins will see primary use cases in remittances, cross-border payments, or in investing in tokenized markets. Like if a market is using blockchain technology underneath, then they're going to have to use stable coins. Also, another primary use case of stable coins is going to be in the crypto market, where like in crypto market we have never discussed crypto in details outside of like stable coins and tokenizations, but like in decentralized finance, for example, DeFi, there are real ways to make 5 to 10% of yields with almost no risks. Like you are like if you are buying a US Treasury, you are getting like US Treasury is the least amount of risk because it's guaranteed by the United States government, right? And the US government is paying you anywhere from like 4% to 5% in yearly interest. In crypto, with a very similar amount of like no, almost non-existent risk, you can earn up to like 8% to 10% in a yearly yield. Now obviously these are a bit more technical, a bit more esoteric, so if you have to be a savvy trader for you to be able to take advantage of this. But that opportunity exists, and more people are going to learn about it, and more people are going to basically venture into the world of crypto, look into tokenized stocks, look into tokenized treasuries, and invest there. So, does the entire circulating money supply of the world gets converted into stable coins? No. But what is the size of stablecoin market cap today? It's at 250 billion, and with the right infrastructure and the right amount of awareness, we are easily looking at a 30 to 35 trillion dollar stablecoin market in the next 10 years.
Could you hear the background noise?
Oh yeah.
We should need to do the outro once more.
All right, let's end it here. I think we have got enough for one day.
Let them stop. We can do the last 1 minute. That are, it looks like they are more important. We have to stop. Anyways, continue. Yeah.
Do you have any more questions?
No, no, no. You can continue with the bit you're saying, and we can end it.
Yeah, I mean, I think yeah, let's just keep it. I think it was good enough. The background noise won't be an issue because we just ended there.
Okay. Sure.
Yeah.
You want to do that?
All right, so let's end it here. I think we have got enough for one day.
Yeah.
Um yeah, let's keep digging deeper and deeper, and
Another dense episode.
yeah, absolutely. Loving it, love the researching process, and the more I
Yeah.
research, I also get to know a lot of the stuff that I previously didn't know. You know, and actually, I'm going to write an article about what we discussed today. I'm going to paste it in the description,
Mm-hmm.
the link in the description, so anyone who is listening to it can read the article as well on my Substack.